Porsche has just reversed course for the second time in little more than a year, and this time, even its own engineers see it as a major retreat. This isn't being described as a temporary slowdown or a cautious adjustment. It's a clear shift back toward gasoline-powered vehicles, announced through a press release that many inside Porsche likely hoped they would never have to publish. One number explains everything. In 2024, Porsche reported an operating profit of 5.6 billion euros. Just 1 year later, that figure had plunged to only 413 million euros, a staggering 93% decline in just 12 months. For a company once considered the most profitable automaker in the world, the drop was almost unimaginable. The picture becomes even worse when you look only at Porsche's automotive business. Excluding its financial services and other operations, the company's automotive operating profit collapsed by 98%, falling to just 90 million euros. And instead of recovering, Porsche continued cutting deeper. Thousands more jobs were eliminated, major product plans were reshuffled, and the company began abandoning some of the ambitious electric vehicle strategies it had promoted only a few years earlier. Its flagship SUV lost its status as an electric-only model. A planned hybrid luxury sedan was delayed indefinitely. These weren't isolated decisions. They were signs of a much larger shift. This is the story of how one of the safest and most admired companies in the automotive world became one of the industry's biggest warning signs, and then repeated many of the same mistakes all over again. To understand how dramatic this reversal has been, you have to go back just 4 years. In 2022, Porsche wasn't simply a successful car company, it was arguably the most profitable automotive brand in the world on a per-vehicle basis. That year, Porsche sold around 309,000 vehicles and generated approximately 6.8 billion euros in operating profit, achieving an operating margin close to 18%. In an industry where even an 8% margin is considered excellent, Porsche was operating in an entirely different league. The company earned more profit per vehicle than almost any other automaker, despite producing only a fraction of the volume of mass-market brands like Toyota. Porsche's success became so remarkable that, in 2022, it accomplished something rarely seen in the automotive industry. The company was partially spun off from Volkswagen and listed on the stock market, raising roughly 9 billion euros with a valuation of nearly 75 billion euros. For a brief period, Porsche's market value actually exceeded that of Volkswagen, the parent company that still controlled most of it. It was a remarkable achievement for a brand that had already survived decades of challenges, including the 1973 oil crisis, near bankruptcy during the early 1990s, and multiple global economic downturns. If someone had asked which car company seemed almost impossible to fail, Porsche would have been the answer for many industry experts. That reputation gave enormous weight to Porsche's next big decision. In 2020, the company introduced the Taycan, its first fully electric vehicle. This wasn't a cautious experiment or a limited trial. It was a bold declaration that Porsche intended to dominate the premium electric vehicle market just as it had dominated sports cars for generations. The following year, then CEO Oliver Blume made the strategy official. By 2030, Porsche planned for 80% of all vehicles sold to be either fully electric or hybrid. The Cayenne, Macan, Panamera, and 718 were all expected to transition toward electrification. Only the legendary 911 would continue relying primarily on its gasoline engine, preserving what Porsche considered the heart and soul of the brand. To support this ambitious vision, Porsche invested nearly 4.4 billion euros in electric vehicle production, new manufacturing facilities, and advanced vehicle platforms. The company also partnered with Swedish battery manufacturer Northvolt to supply battery cells for its future electric lineup. Initially, the strategy appeared to be working. The Taycan received widespread praise from critics, won multiple awards, and reached peak annual sales of more than 41,000 units in 2021. For an electric luxury sedan with a starting price above $90,000, those were impressive numbers. Many analysts even described it as the thinking person's Tesla, believing Porsche had finally discovered the formula that many traditional automakers had struggled to achieve. As the pressure mounted, Porsche made a move it had avoided throughout its entire history. The company began offering massive discounts on its vehicles. In some markets, Taycan prices were reduced by as much as 35%, while even the iconic 911, a model that almost never received discounts, was marked down by more than 10% simply to clear dealer inventory. It may have helped move cars, but it came at a huge cost. For decades, Porsche had built an image around exclusivity. Buyers believed that a Porsche was never discounted. That reputation had been one of the brand's greatest strengths, and now it was beginning to disappear. By May 2024, the situation in China had become even more serious. Dealers were refusing to accept additional deliveries because their lots were already overflowing with unsold vehicles. Some even demanded financial support from Porsche's headquarters in Germany to help deal with the growing inventory crisis. Then, another major setback arrived. In November 2024, Swedish battery manufacturer Northvolt, Porsche's key battery supplier for its future EV lineup, filed for bankruptcy. Overnight, one of the company's most important electric vehicle plans was thrown into uncertainty. The impact was immediate. The next-generation electric 718 Boxster, originally expected to launch in 2025, was delayed until at least 2027. A few months later, in August 2025, Porsche shut down its own battery production operation, laid off around 200 employees, and wrote off nearly 400 million euros in investments that would never generate a return. The electric Macan also failed to deliver the success Porsche had hoped for. After already being delayed by software problems, it reached customers more than a year late and sold only about 18,000 units during its first partial year on the market. It also carried a price tag roughly $30,000 higher than the gasoline version, while many technology-focused buyers already considered its platform behind the competition. Inside Porsche, tensions were no longer hidden. By February 2025, disagreements among senior executives had become public. The conflict became so serious that Porsche dismissed both its chief financial officer and its head of sales after they openly contradicted CEO Oliver Blume. At the same time, the company's financial outlook continued to deteriorate. Its expected operating margin dropped from healthy double-digit levels to 6.5 to 8.5% in April. Just a few months later, that forecast was cut again to only 0 to 2%. Then came perhaps the biggest strategic reversal of all. The ambitious goal of making 80% of Porsche sales electric by 2030 quietly disappeared. Instead, the company replaced it with a much less specific commitment, saying it would continue producing gasoline, hybrid, and fully electric vehicles for the foreseeable future. In July 2025, a letter sent to Porsche's 36,700 employees in Germany confirmed what many inside the industry had already suspected. CEO Oliver Blume acknowledged that sales in China had fallen to historic lows. He admitted that electric vehicles were generating much lower profit margins than traditional gasoline models, while new tariffs in the United States were creating additional financial pressure. The conclusion was clear. The business model that had once seemed unstoppable was no longer working under current market conditions. To reduce costs, Porsche announced plans to eliminate 3,900 jobs by 2029. The company also capped annual production at 250,000 vehicles, roughly 20% below previous targets. Taycan production was reduced from 2 manufacturing shifts to just 1. Many believed that this marked the lowest point of Porsche's crisis. It didn't. Only 3 months later, Porsche's board decided it was time for new leadership. After spending nearly a decade leading Porsche, while also serving as CEO of Volkswagen, Oliver Blume came under growing criticism. Investors felt the company needed a leader fully focused on Porsche instead of splitting responsibilities between 2 major automakers. During his tenure, Volkswagen's share price had fallen by nearly 30%, while Porsche's own stock had lost roughly half its value since the company's 2022 public listing. In October 2025, reports revealed that Porsche had entered negotiations with Michael Leiters, the former McLaren executive and Ferrari veteran who had also spent 13 years earlier in his career at Porsche. Leiters officially became Porsche's sole CEO on January 1st, 2026, inheriting a company already facing one of the toughest periods in its history. Unfortunately, the worst numbers were still ahead. On March 11th, 2026, Porsche released its full financial results for 2025, and Leiter's first earnings presentation painted a grim picture. Group operating profit had fallen to just 413 million euros, a staggering 93% decline from 5.6 billion euros the year before. The automotive division performed even worse, with operating profit dropping 98% to only 90 million euros. Revenue declined 9.5%, finishing the year at 36.27 billion euros, while profit after tax collapsed 91% to just 310 million euros. The Taycan, once celebrated as proof that traditional automakers could compete successfully in the electric era, sold only 16,339 units during the year, more than 60% below its 2021 peak of 41,296 vehicles. Facing these challenges, Michael Leiters summarized his recovery strategy in just 3 words: leaner, faster, more desirable. Yet hidden within Porsche's 2026 guidance was perhaps the clearest sign that the company's ambitions had fundamentally changed. The automaker that once promised 80% electric sales by 2030 was now expecting battery electric vehicles to account for only 24% to 26% of total sales. And the retreat from electrification didn't stop there. In February 2026, reports confirmed that Porsche's flagship K1 SUV, originally designed as an all-electric showcase built on Volkswagen's dedicated EV platform, was being completely re-engineered. Instead of remaining electric only, the vehicle would now use Audi's combustion engine architecture, sharing its foundation with the upcoming Audi Q9 and offering turbocharged V6 and V8 engines. The SUV that was once meant to prove Porsche could build a large-scale electric flagship had become, by design, a gasoline-powered vehicle first. Around the same time, additional reports revealed another major change. Porsche was backing away from its promise that the next-generation Boxster and Cayman would be electric only. Instead, both models were expected to continue offering combustion engine versions alongside any electric variants. That brings us to the latest announcement, the one that prompted this entire discussion. On July 22, 2026, Porsche's supervisory board approved another sweeping restructuring plan. And by the company's already difficult recent standards, it was one of the most aggressive cost-cutting measures yet. The restructuring isn't over yet. Under CEO Michael Leiters, Porsche is reportedly preparing another round of cost-cutting that could eliminate 5,000 to 6,000 more jobs by 2035. These cuts would come on top of the 3,900 positions already scheduled to disappear under the previous restructuring plan. At the same time, Porsche confirmed another major setback for its electric strategy. The fully electric Panamera, once expected to be a key pillar of the company's EV lineup, has been pushed well into the next decade, and the company has not announced a new launch date. Reports also suggest Porsche is distancing itself from the Volkswagen Group's software partnership with American EV startup Rivian. That collaboration was once viewed as an important step toward improving Porsche's future electric vehicles, but now it appears to be losing priority as the company shifts its focus. Adding to the changes, a new production chief is set to take over in September. According to one anonymous Porsche engineer, quoted by the German press, walking through the halls of Porsche's headquarters in Zuffenhausen today feels like watching the company rewind an entire decade. And that's exactly why this story matters, even if you'll never own a Porsche. For years, Porsche represented the perfect test case for the electric vehicle transition. The company had some of the highest profit margins in the automotive industry, decades of engineering expertise, one of the world's strongest luxury brands, and a significant head start over many of its competitors. If any traditional automaker seemed capable of leading the shift to electric vehicles successfully, Porsche was the name almost everyone pointed to. Yet things didn't unravel just once. The first major turning point came in 2025, when Porsche quietly abandoned its goal of making 80% of its sales electric by 2030. Now, even after appointing a new CEO, introducing a revised strategy, and launching another aggressive restructuring plan, the company finds itself facing another public setback. That reality is likely making executives across Munich, Stuttgart, Detroit, and beyond pay very close attention. If Porsche, with all of its engineering talent, financial resources, and brand prestige, couldn't outpace new competitors like Xiaomi, a company that entered the automotive industry from the smartphone business, what does that mean for everyone else? It's a question many automotive leaders are probably asking behind closed doors. But there's another lesson here that's arguably even more important. Porsche didn't simply invest in electric vehicles. It built much of its long-term strategy around a single, ambitious timeline. When market demand failed to grow as quickly as expected, that entire plan became difficult to sustain. Its battery supplier collapsed. Factories had already been reconfigured for an electric future that wasn't arriving at the pace the company had anticipated. Vehicles like the flagship K, one SUV, along with the next-generation Boxster and Cayman, had to be redesigned during development because customer demand no longer matched Porsche's original assumptions. Meanwhile, automakers that continued offering gasoline, hybrid, and electric vehicles at the same time now appear to be in a stronger position. Not necessarily because they chose the perfect technology, but because they never committed the future of their entire business to a single outcome. Ultimately, Porsche's struggles weren't caused by building a bad electric car. In fact, many engineers and automotive journalists still consider the Taycan one of the best driving electric vehicles ever produced. The bigger issue was something far more challenging. The company discovered that brand prestige alone cannot overcome limitations in driving range. A legendary heritage cannot erase a significant price difference. And decades of racing success cannot guarantee victory against a technology company that delivers faster software development and more advanced digital features. Today, Porsche finds itself caught between two very different groups of customers. Longtime enthusiasts still want the sound, emotion, and character of traditional combustion engines. Modern EV buyers, on the other hand, expect cutting-edge software, rapid charging, seamless connectivity, and the kind of technology increasingly offered by Chinese manufacturers and companies like Tesla. At the moment, Porsche hasn't completely satisfied either audience. Its vehicles remain too expensive for some buyers, while others believe the technology still trails behind the competition. Even with new leadership, there is no easy answer for how the company escapes that position. And that's why Porsche's latest announcement has attracted so much attention across the automotive industry. The company was expected to become the strongest proof that established automakers could successfully navigate the transition to electric vehicles. Instead, it has become one of the industry's biggest cautionary stories. Executives at BMW, Mercedes-Benz, Audi, and many other manufacturers are undoubtedly studying Porsche's experience and asking themselves the same difficult question. If this could happen to Porsche, despite all of its advantages, what makes us believe we're immune? Now it's your turn. Do you think Michael Leiters's new strategy can put Porsche back on track? Or will the company continue restructuring without solving its deeper challenges? Share your thoughts in the comments. I genuinely enjoy reading them, and many of the best topics featured on this channel have come directly from viewers like you. If you're new here, welcome to Motor Zen. This channel explores every side of the automotive world, from engineering and design to business strategy and automotive history. Rather than taking sides, we simply follow the facts wherever the story leads. If that's the kind of content you enjoy, consider subscribing. New videos are released every other day, focused on meaningful stories without unnecessary filler. Thanks for watching, and I'll see you in the next video.